Thank you for joining me for a more in-depth look at a technique that could help you to spot the next bear market. Now, bear markets are usually defined as a 20% decline in the Dow Jones Industrial Average. Under this definition, that means the 19.2% decline in the Dow that occurred in 2011 wasn't a bear market. Now, if you were invested at that time, it certainly felt like it. And because of that, I prefer to use more expansive definitions than the traditional one. For example, a 13% decline over about a 5-month period, that would be a bear market. You'd suffer a large loss over an extended period of time, or a relatively large loss. Now, the best definition of a bear market, I believe, could simply be an adaptive tool that highlights the best times to take defensive action. And I've shown this chart in the article. This is the 5-month moving average model, and it adapts to the current market environment. Now, a bull market begins when prices close 3.6% above the moving average, and the bear market begins when prices close 4.8% below that average. The asymmetric parameters are very important to this model. They recognize that bear markets end suddenly and prices tend to rally sharply. By having a shorter period of time until we can get back in, we're able to minimize risk while maximizing potential gains. Now, we can test this. And when I tested it, it tests very well, actually. Overall, the system, going back to the beginning of the S&P 500 in 1928, captures 88% of the total points that a buy and hold investor would earn. Now, usually a moving average system will capture less than 70% of the buy and hold investment. Moving averages historically underperform a buy and hold investment. The win rate for this particular system of 47%, that's actually, again, pretty good. A moving average system is usually in the low 40s. And the win rate for long trades, for buying, accurate 61% of the time, that's exceptional for a moving average-based strategy. Again, remember, they're usually in the 40s. The value of this strategy is in how it reduces risk. If you were a buy and hold investor in the S&P 500 since inception, the largest loss you faced would have been 87%. Twice since 1999, you would have had losses of more than 45%. Using this model, your largest loss would have been only 25%. That's a dramatic reduction in risk. And that means this is a useful tool if you're concerned about reducing risk. No strategy is ever going to avoid all of the drawdowns. You're always going to have a period of time when a system suffers a series of losses. And there's certainly better strategies than this one, but what I like about this one is its simplicity. Almost anyone could chart this and follow it. And to start you off on your charting and following this system, I'm giving you the next bear market signal, which will require a close below 25.56, and that's for now. That average, or that number, will change over the coming days and weeks. So that's only a snapshot in time, but that's the number to watch for. About 25.56 on the S&P 500 would indicate we're more than likely headed for a bear market. Thank you for joining me. I hope this was beneficial to you.